Hello students, today we will learn about the depreciation which is covered under section 32 of the Income Tax Act. So now we'll see what is this depreciation. Depreciation is nothing but it is a decrease in the value of an asset. So the decrease in the value of asset may be due to wear and tear, that is the value of asset decreases due to continuous usage in the business. Due to passage of time or obsolescence, the value of asset decreases due to some technological factors like assets becomes out of date. Because of these factors, the asset value decreases. So as per the provisions of section 32 of our Income Tax Act, it is mandatory to record a depreciation on the debit side of a profit and loss account of every business. So while calculating their total income, in order to file their income tax, they have to calculate their total income. So while calculating their total income, they have to record their 5 heads of income. Like section 15 income from salary, section 22 income from house property, section 28 business income or professional income, section 45 capital gain, section 56 income from other businesses, income from other sources. So in order to file their income tax, they need to calculate their gross total income, and from that they have to provide deduction under section 80. So the total income of SSC, income tax is calculated. So in order to calculate this total income, they have to here we have to learn about this business income. So under that, the depreciation is one of a allowable deduction under section as per section 32. It is a allowable expenses in the business. They have to record the depreciation on the debit side of their profit and loss account. So if you are preparing this profit and loss account, so on the debit side of profit and loss account, we have to record depreciation to depreciation. We have to record depreciation here. We have to record depreciation here to depreciation on the debit side of profit and loss account of every business. So this depreciation should be recorded as per the section 32, as per the provisions of section 32. So now we'll see what is the provision or conditions as per section 32. So there are mainly two conditions in order to record a depreciation as per section 32. That is, the first condition is the assessee must own an asset. He should own an asset. The second condition is the asset should be used for a business or profession. So now we'll see the format for the calculating the depreciation under section 32 of our Income Tax Act for the assessment year. 2 columns, we have to draw 2 columns, particulars and amount. Firstly, we have to take written down value of the asset at the beginning of the year. So for calculating depreciation for income tax purpose, we have to follow the written down value method, and the value of asset we have to take as per the written down value of the asset at the beginning of the year. And plus we have to add additions or purchases. If there is any asset purchased during the previous year, we have to add, and to the added value we have to deduct the sales or transfer. If there is any sales or a transfer, or if there is any insurance claim received for the damage of asset or any value of scrap, then we have to deduct. The value will get is written down value at the end before depreciation, before charging depreciation. Next we have to charge a depreciation. We have to deduct the depreciation. The final value will get is written down value at the end after charging depreciation. Now to calculate, these values will be directly given in the question. The depreciation we have to calculate here. Now we see the points, some points to be remembered while calculating the depreciation. So here to calculate the depreciation, we have to calculate 2 kinds of depreciation. One is normal depreciation, second one is additional depreciation. So the first one, normal depreciation, we have to calculate the normal depreciation at the rate prescribed for the asset. So there may be assets like furniture, building, plant and machinery. So we have to calculate the depreciation, the normal rate. So the rate of depreciation for furniture may be 10% or plant and machinery may be 15%. So that is a normal depreciation we have to calculate. And here, if the asset used less than 180 days in a previous year, then we have to take 50% of depreciation. In case of normal depreciation, if any of the asset is used less than 180 days, means in a one previous year, the year starts from 1st April 2019 to 31st March 2020. So if the asset is purchased in the middle of the year and the asset is used in the business only for a less than 180 days, then we have to take only 50% depreciation for that, for the newly purchased asset. So if asset is used less than 180 days, then we have to charge depreciation only 50%. Second point is we have to calculate the additional depreciation. The additional depreciation should be charged only on new plant and machinery. That is not charged on any other asset. It is charged only on new plant and machinery, and the rate of additional depreciation will be at 20%. Here also, if the new plant and machinery is used less than 180 days in the business in a particular previous year, then we have to take 50% of depreciation will be allowed. So only two depreciation we have to calculate: normal depreciation and additional depreciation. Normal depreciation is applicable to all kinds of asset, all the block of asset, and if the asset is used less than 180 days, then we have to take half of the depreciation, and additional depreciation will be allowed only for the new plant and machinery, and that is also at 20%. If that new plant and machinery is used less than 180 days, then we have to take 50% of depreciation. So this is the main points we have to remember while calculating depreciation as per the provisions of section 32 of our Income Tax Act.